Welcome to INV FL, where investing meets clarity. In this breakdown, we're analyzing PepsiCo, ticker symbol PEP. PepsiCo is a global food and beverage titan with a portfolio that reaches virtually every household on Earth. With brands like Pepsi, Gatorade, Doritos, Lay's, Quaker, and Mountain Dew, it combines iconic branding with mass market reach. The company operates in over 200 countries and has a market cap of around $180 billion. Shares are currently trading in the low 130s, with a forward price-to-earnings ratio of around 19, notably below its historical average. The dividend yield stands at approximately 4.35%, making it one of the highest among large-cap consumer staples. PepsiCo's business model is built on balance. About 53% of revenue comes from snacks and 47% from beverages. This dual-engine approach helps smooth performance during periods of volatility. In times when consumers cut back on one category, the other often compensates. Financially, the company generates strong and reliable free cash flow. This enables it to fund operations, invest in innovation, and return billions to shareholders through dividends and buybacks. That said, PepsiCo isn't without its risks. Commodity costs, particularly corn, sugar, and aluminum, have been volatile. Foreign exchange rates can also weigh on results due to its global footprint. Meanwhile, health-conscious consumers are shifting toward low-sugar and functional products, pressuring some of its legacy offerings. And like many global companies, it faces growing regulatory burdens across regions. Despite these headwinds, PepsiCo continues to reward investors. The company has raised its dividend for over 50 consecutive years, placing it firmly in dividend aristocrat territory. Its annual payout currently sits at $5.69 per share, supported by healthy cash flows and a strong balance sheet. It also continues to buy back shares aggressively, with nearly $200 million repurchased in the first quarter alone, and a total of $7.6 billion expected to be returned to shareholders this year through dividends and buybacks. PepsiCo is not a growth rocket, but it's a global compounder. For investors seeking reliable income, brand resilience, and strong global operations, it's a stock worth serious consideration. Let's break down PepsiCo's business quality across 5 key categories. Each one is scored out of 20, for a total quality score out of 100. First, financial health, 18 out of 20. PepsiCo has dependable earnings, low leverage relative to its cash flows, and the ability to fund both operations and shareholder returns comfortably. Next, capital return, 19 out of 20. This includes both dividends and buybacks. With a 4.35% yield, over 50 years of dividend growth, and consistent share repurchases, PepsiCo is built for returning value. Growth potential comes in at 16 out of 20. While not a fast grower, PepsiCo has pricing power, expanding product lines in wellness and sustainability, and a strong foothold in emerging markets. For management and strategy, 17 out of 20. Execution remains disciplined. Management invests in innovation, controls costs, and maintains a long-term focus that supports shareholder value. Finally, durability and moat, 17 out of 20. With some of the most recognizable consumer brands in the world, PepsiCo has pricing power, shelf dominance, and strong retailer relationships that create long-term staying power. Based on all these factors, our fair value estimate for PepsiCo sits between $145 and $155 per share. That brings us to the INVFL quality score, 87 out of 100. Thank you for watching. If you value quality business analysis, consider subscribing to INVFL. Thanks again.